No change, Julie.
No change. So let's get back to Michael Darda, because, Mike, obviously you were in the middle of answering a question. I'm imagining that the language you were talking about, the Fed perhaps eventually will telegraph that it's going to begin to change things, but it's not coming today.
Exactly. So the language will change before the balance sheet changes. The balance sheet will probably change before short-term interest rates head up, or maybe they could, be changing in a simultaneous fashion. My guess is that they're going to probably have to shrink the balance sheet for a while, even to get Fed funds off the floor. So that's coming later on. But I think you're probably going to need to see several relatively strong labor market reports before they even kick extended period out of the language. And even then, they still may wait a while. Fed Chairman Bernanke's going to want to see that unemployment rate move down in a convincing fashion. Core inflation's dead in the water for now, and they're focused on loan growth. Loan growth is a lagging indicator, but for the Fed, it's probably going to end up being a leading indicator, meaning I don't think you're going to see that Fed funds rate headed upward or the balance sheet coming down until commercial bank credit starts to expand in a convincing fashion.
And Guy Lebas, Michael Darda, he spoke jobs, he spoke the employment picture. How many consecutive months of job growth are we going to have to see before the Fed decides to make a decision on this?
Well, if you look in past periods of recovery from the sort of similar type recessions, consumer-oriented recessions, it seems to be the Fed waits as long as 12 to 24 months of declining unemployment numbers before they really take time to act. I think in the current environment, because the low level of Fed funds was actually not just driven by economic conditions, but also financial conditions, they're more likely to withdraw that extraordinary accommodation a little bit early. We're looking really for the December meeting, and I think there's sort of a series of 6 steps the Fed has to go through before we're all the way there.
I want to bring in some of the language of the statement. Obviously, they kept the phrase extended period in there. They also kept the phrase that the committee will continue to monitor the economic outlook and financial developments, will employ its policy tools as necessary. In other words, they did not make any change in the way they talk about asset sales. So nothing public on that, although we may find out during the minutes that they did discuss the issue. They did change a little bit of their economic outlook. They said that we are seeing improvement in labor markets, but they add a caveat that employers remain reluctant to hire, and no change in sort of the key phrase about the economy. They told us back last fall that it was going to be slack that makes the difference in whether or not they raise rates. Well, the committee anticipates a gradual return to higher levels of resource utilization in a context of price stability. Same phrase that they have used, so they're not seeing the speeding up of growth that we've seen in the last couple of quarters and in recent weeks, adding any additional urgency to a rate change.
Yeah, Michael Darda, given what our economic senator Michael McKee just told us, anything in the language jump out at you or surprise you?
No, not really. I think this was as expected. And if I could just pick up on Mike's point as well, the Fed is focused on the volume of labor market slack. And because this was such a deep recession, there's much more of it than we've seen in a long, long time. For example, if you go back to the early 80s, the last time you had this kind of volume of labor market slack, inflation was much higher. So you've not only got you not only have the slack part of the picture in place for the Fed in terms of their concerns, but you've got sub-comfort zone core inflation with a high volume of labor market slack. I think that's going to make the Fed less willing to pounce on the recovery, especially considering that, what we were faced with in 2008 and early 2009. I think the Fed would rather be a little bit behind the curve and play catch-up later than move too soon, strangle this recovery, and then be back in the business of unconventional monetary policy.
Well, Guy Lebas, let me put it to you then, because we have been seeing, at least for a year, an economy that has been growing. As Mr. Bernanke had called it earlier, a nascent recovery. We have signs pointing to stepping away from the abyss, as the White House likes to say. But again, there is that nagging, lagging indicator of 9.7% unemployment.
Absolutely. I think that the Fed's choice of word, the reluctance of employers to begin hiring, that actually strikes a very key tone. Maybe it's reading a little bit too much into the specific language, but it suggests to me that the Fed is not necessarily relying on just the month-to-month numbers, how many people are getting jobs, but they're focusing on talking to hiring managers, getting that kind of qualitative aspect to try to determine future plans, you know, what these companies are gearing up for 3, maybe even 6 months down the road. And I think that's more likely to determine the Fed's perception of how the labor market is doing than the past tense numbers are.
Guy, I want to bring you in on this Treasury discussion because on the one hand, the Fed is eventually going to raise rates, so you do have some people who are shorting the Treasury market as a result. At the same time, there's the point that Dom and Adam were just making, which is that the U.S. still perhaps looks like the best of the bad choices maybe that are out there. So what's your view on Treasuries right now?
Well, our view on Treasuries is that we're certainly not looking for a massive spike in interest rates anytime soon, particularly when you look about the long-term interest rates. You know, if you look at the 10 to 30-year area of the yield curve, those interest rates are driven not by economic conditions today, for the most part not by budget fears, they're driven primarily by inflation. And as Mike earlier was saying, inflation really remains an outside risk at the moment. So as long as that is the case, and will probably be so for another year or so, we're not looking for any dramatic increase in longer-term Treasury rates.
All right, Michael Darda was wondering if we could get your comments on that as well and how those treasuries are playing into this.
Sure. You know, our view on the long Treasury yields has been, you know, that they probably push up some, but they don't spike higher. So I agree with Guy on that point. And also, to some degree, let's remember this. I mean, the 10-year T-note went to 2% in the throes of the credit crisis and has recovered with risk appetites and with the economy. So to some extent, people get really worried when they see those long rates push up some, but we've been in a range. We're still well below pre-Lehman levels. And frankly, it's a high-class problem if you've got an economic recovery that normalizes the yield curve versus, you know, Great Depression 2.0 and everybody wants to pile into, you know, so-called riskless securities.
All right, let me quickly ask you both, since we didn't get any action today, speculate on what we're going to find out in the minutes. Did they agree at all on the idea of selling any of their mortgage assets? And do you think they set a framework for an exit, well, at least some sort of timing or a plan for whether they go with rate increases or balance sheet drains first? Guy?
Well, I think balance sheet drains and particularly asset sales focused on the mortgage market is the obvious first choice. Several Fed policymakers have said they're not interested in playing the game of affecting the mortgage market specifically. I believe there were some speeches back in February. And I think that sets the stage for these policymakers to encourage mortgage-backed security sales as first choice. Plus, the other side of it, the markets have a huge appetite for mortgage backs these days.
All right, and Michael Darda, your thoughts?
I think the Fed will be data dependent. To some degree, the Fed is backward looking here, so it will follow, not lead. Probably the balance sheet's going to have to come down to effectuate higher short rates, and it doesn't happen likely until late this year at the very earliest in our view.
Michael Darda, Guy Lebas, our economics editor Michael McKee, all joining us on this Fed Day. Gentlemen, thank you so much. Julie?
Thanks a lot. My pleasure.